To begin the week, global markets took a beating as concerns rose that the United States Federal Reserve would need to raise interest rates more aggressively than planned. The May Consumer Price Index reading in the United States was 8.6% year-on-year, the highest since 1981, prompting the market to price in a 75 basis point boost from the Federal Reserve on Wednesday. Markets anticipate 9 to 10 rate increases from now until early 2023, with at least 50 basis point increases at each of the next 3 Federal Open Market Committee meetings and a terminal rate of 4%. What do you know about the global recession? Let me give you a little insight. Because a more aggressive Fed is likely to have repercussions throughout the global economy, Friday's inflation report ignited a multi-day sell-off in stocks globally. The United States inflation report on Friday influenced markets around the world, which seems fitting considering that the Fed is, to some extent, the world's central banker and could likely contribute to a global recession. The US will still avoid a recession, and the Fed will be able to arrange a soft landing by remaining sufficiently hawkish while being data responsive. She did, however, acknowledge that the US economy is weakening and that achieving a soft landing is getting increasingly difficult. Given that monetary policy is a blunt instrument, not a surgical tool, slowing just enough to temper inflation but not induce a recession is an extraordinarily difficult balancing act. As a result of last week's CPI report and consumer inflation expectations data, recession risks have increased. A US recession, particularly one precipitated by an interest rate hike cycle, would reduce global import demand and destabilize financial markets. Moving on to the central bank knock-on effect, the European Central Bank reaffirmed this week that it intends to raise its main interest rate by 25 basis points at its July meeting, with another hike scheduled for September. However, the ECB scheduled an emergency monetary policy meeting on Wednesday after bond yields for numerous Eurozone states rose. The unexpected meeting held before the Fed's announcement was noteworthy. It probably suggests that they are scared that the Fed would execute major rate hikes, such as the 75 basis point boost that we are expecting, and that this will have some influence on risky assets in the market, as well as exacerbate fragmentation in European government bond markets. The currency consequences of the Fed's anticipated hawkish tilt could impact European policymakers. It certainly implies that we may see a higher dollar and, as a result, a weaker euro, which has already been a source of concern for numerous ECB officials. If we were ready to move towards parity, I believe a weaker euro, even if this is not an ECB aim, contributes to inflationary pressures and is thus a problem. This could imply that the ECB's hawks will advocate for more rate hikes than they currently have planned to counteract the inflationary impact of a lower euro. With financial conditions tightening and a global sell-off in risk assets beginning, the traditional haven US dollar has surged in recent trading sessions. The imbalances that are fueling dollar strength are not going away anytime soon. The US economy is significantly less sensitive to tighter financial conditions caused by exchange rate movements when compared to trade-heavy economies such as Switzerland, Japan, and even the Eurozone, and there are many emerging markets. Because global commodities are valued in dollars, a stronger dollar in this climate is not beneficial to them. While the dollar is likely to remain strong, the Fed's aggressive posture may allow the ECB, Swiss National Bank, and Bank of England to tighten more to support their currencies. It truly works both ways, and if the other central banks can be a little braver in pushing for appreciation, allowing their currencies to strengthen through rate hikes, I believe that can help redress the balance and possibly cap the dollar. But for the time being, I believe most portfolio managers and investors will continue to favor the US dollar. The profit recession. Along with the threat of a worldwide economic downturn, investors should be mindful of an impending profit recession. Given the continuous themes of deglobalization, increased energy and input costs, and higher wages, the more than 25-year pattern of profits increasing as a percentage of GDP was more or less finished. The problems posed to supply chains and expenses as a result of the Ukraine crisis and geopolitical divergences have exacerbated the threat of higher rates to corporations. The world's largest economy's stock market has had its worst start to a year in 60 years. with the S&P 500 benchmark index down 23% since January and dropping another 3.75% on Thursday. The current status of the S&P 500 suggests an 85% risk of a US recession. The declines, which were matched in the Dow Jones Industrial Average, the tech-heavy Nasdaq, and the UK and European markets, did nothing to boost confidence in the Asia-Pacific. The Nikkei 225 in Tokyo was down 1.65% and on course for its worst week of losses in 2 years, as was India's Nifty index. On Friday afternoon in Sydney, the ASX 200 was down 2%. We all know there has been a downfall in the crypto market in the past months. So, how is it affecting the global economy? The cryptocurrency crash shows no signs of abating, with Bitcoin down 7.8% and Ethereum down 8.45%. Furthermore, the Financial Times claimed that Three Arrows Capital, a Singapore-based crypto hedge fund with $10 billion under management, failed to fulfill margin calls this week due to the drop in crypto valuations. The prospect of the Ukraine conflict extending and the West's economic war in Russia resulting in significantly higher energy costs ahead of the Northern Hemisphere winter aggravates the situation. The speed and degree of policy tightening may be too much for economies to absorb, particularly given the present commodity price shock, economists at Australia's NAB Bank wrote in a report on Friday. As a result, the likelihood of recession for several major advanced economies, including the United States, is uncomfortably high. The prolonged coronavirus lockdowns in China are complicating matters further for the global economy. Supply chain snarl-ups in the world's second-largest economy, which began during the pandemic, are expected to last at least until next year, thanks to the shutdown of Shanghai and other vital regions. The larger picture is that China was already dealing with issues such as decoupling from the West amid geopolitical tensions, a faltering, massively indebted property market, and the uncertainty produced by President Xi Jinping's crackdown on large digital firms. As the West raises interest rates, China's central bank has been decreasing them, and the Beijing government has been injecting additional stimulus into the economy. It helped mainland shares and the Hong Kong market reverse the downward trend in Friday trading, but it may not be enough to refloat the global economy in the same way that its enormous $4 trillion stimuli did after the 2008-09 global financial crisis. Some criticize that Bank of England's decision to boost interest rates by 0.25% on Thursday as being too little, too late to halt inflation. According to one projection, prices will rise by 11% by October, while another source claims that food price increases could reach 15% in the autumn. The Eurozone is also stumbling and divided over how to deal with diverging real borrowing rates between countries, which means Italy must pay more than Germany while having the same currency. According to the Economist Intelligence Unit or EIU, while the US recovered from the pandemic recession faster than other nations, there were signs that consumer spending was declining. Its basic assumption is that US growth will stall short of a recession, but it could be close. The EIU score estimate is that economic growth in the United States will drop considerably throughout 2022 and 2023 owing to persistently high inflation, rising interest rates, and stalled growth elsewhere. We anticipate that consumer demand will be sturdy enough to avert a full-fledged recession, owing in part to a tight labor market and robust household balance sheets. However, this does not rule out the possibility of a recession. We think that everyone has the right to knowledge based on science and truth, as well as analysis based on authority and honesty. That's why we made a different decision: to keep our reporting accessible to all readers regardless of where they reside or how much they can afford to pay. More people will be better informed, united, and inspired to take meaningful action as a result of this. A truth-seeking global news organization like The Guardian is critical in these frightening times. We have no shareholders or wealthy owners, which means our work is free of financial and political influence. This distinguishes us. Our independence empowers us to fearlessly investigate, confront, and expose those in power at a time when it has never been more necessary. I believe that regardless of what happens in the economic outlook, and certainly the likelihood of an economic recession is increasing, the likelihood of a profit recession is increasing much quicker. You can keep watching this channel to keep yourself updated on global information like this. Share your thoughts in the comments section and click the like icon, and also hit the notification bell. See you guys in the next video coming up.